Hello and welcome to Moneylife News and Views. I am Debashis Basu. India's economy continues to post headline numbers that would make most finance ministers envious. Gross domestic product is forecast to grow at 7.4% in FY26 according to National Institute of Public Finance and Policy. The baseline is a 7.19% growth, rising to 8.8% in a much sunnier scenario. Moody's Ratings expects India to be one of the world's fastest growing big economies in 2026 and 2027 at 6.4% and 6.5%. That's a bit more conservative, but still fantastic by world standard. With global growth stuck at 2.5 and 2.6% and China slowing down to 4.5%, India's trajectory looks very impressive. Now turn your gaze to corporates results for the September quarter, which is in fact a trend that's been continuing for the past few quarters. Revenues of Nifty 50 rose a mere 7%. Operating profits grew 13% and net profits by just 9%. For decades, a convenient rule held that Indian firms grew their top line 3 to 4 percentage points faster than GDP. That rule, borrowed from Western corporate cycles, has not merely frayed, it is now collapsed. The broader NSE 500 shows much the same. Revenue growth of 7%, operating profit growth of 15%. Only the Nifty Microcap 250 mustered a double-digit sales growth, even though there has been an operating profit growth of just 6%. Muted revenues and jumpy profits have been the norm for the past several quarters. Last year, in fact, for the September as well as for the December quarter, the excuse was general elections and state elections. Nobody is talking about that excuse anymore. The revenues remain muted at single digits. Now, how does that square with consistently high and stable GDP growth? Are you tempted to blame Donald Trump's tariff tantrums? Well, India's export sector has been a laggard forever, and it hardly contributes anything to GDP growth. Net exports contribute, as I said, hardly anything. Of the 5 top export product groups, one of the largest, which is gems and jewelry exports, are from unlisted and smaller firms. So in any case, they do not either positively or negatively contribute to profits of listed firms. They're not relevant. Petroleum exports mostly head to Europe, not America. Electronics and pharmaceuticals were spared from recent tariffs. That leaves only engineering goods, where only a sliver of listed firms felt any pain. Software services, the crown jewel of listed companies' earnings, escaped unscathed. A weaker rupee, this year's worst emerging market performer was India, down 3.4%, should have helped exporters, not hurt them. Only a few sundry companies in the listed space, such as marine products and quartz stone or specialty firms, were affected by tariffs. The explanation for GDP corporate disconnect lies somewhere else. A hint came from Asian Paints, India's largest paint maker and bellwether of discretionary consumption. In May 2024, its managing director remarked, unusually candidly, that the correlation between India's GDP growth and its companies or the paint industry's growth has really gone for a toss. He said he was, I quote, not very sure how the GDP numbers are coming, unquote. Within a day after the comment went viral, there was tremendous pressure on him and he walked it back. But he was onto something important. To start with, let's look at it from the other end. What contributes to GDP growth? Consumption, especially private final consumption expenditure, as it's technically called, is India's colossus, accounting for roughly 61% of GDP. If PFCE grows by 7%, nearly 4 points of GDP growth are already secured. Whether this accurately reflects the state of household finances is of course debatable, and whether these numbers are correct or not, the growth of consumption is correct or not, is not very clear to me, because real wages for most Indians have hardly surged. Even so, PFCE remains the central pillar of the economy. Investment is the next big driver. Gross fixed capital formation makes up 30% of GDP, but the mix matters. Private investment is languishing at a decade-low share of 33% of total capex, hamstrung by tepid demand and familiar obstacles to doing business. Government capex, meanwhile, has been doing the heavy lifting on defense, railways, highways, water systems, and by state-controlled companies. That their capital expenditure is very large. Government consumption, the third leg, contributes to a steady 11 to 12% of GDP and grows roughly in line with the broader economy. Combine a consumption heavy GDP, a state led investment push, and flat private capex, and the paradox of booming GDP and subdued corporate revenues begins to dissolve. Investors assume that rapid GDP growth must automatically translate into buoyant corporate earnings. They have not examined where the GDP growth is coming from. It is coming from private consumption and government expenditure. But if PFCE is growing by around 6.5% in nominal terms, then firms will grow revenues at roughly that pace, as indeed they are, especially in the non financial companies. It is simply unreasonable to expect a 3 to 4% higher revenue growth unless something goes wrong somewhere. And that wrong happened before the current regime took over, when massive private capex, all very, very controversial, created a major boom. The private sector is adept at squeezing double digit profits out of single digit revenue growth, which is what we're seeing. What would align GDP growth to private sector performance? Go back to the composition of GDP growth. The two biggest components of GDP involving the private sector are PFCE, that's private consumption, and private capex. If private consumption grows faster and private capex booms, we will have a much faster GDP growth, and we will see that impacting corporate performance immediately. The first was partly achieved by lower GST rates recently, which boosted consumption last month, though its sustainability is yet to be tested. Unfortunately, the most impactful part of GDP growth, which is private capex, is not budging. Government investment averaged 4.1% of GDP over FY 22-25, up from 2.8% pre-COVID, while private investment share is stuck at near 2%. Policymakers continue to treat private investment as simply a supply-side puzzle to be solved with cheaper capital, tax giveaways, and government-led crowding in, most notably, the production-linked incentive scheme. But the real constraint is demand, which can come from two sources, domestic and external. Domestic demand remains weak since real wages of the vast majority of the people are not increasing. Demand can come from exports, but Indian exports are largely uncompetitive. We should stop admiring the headline growth that captures the aggregate and confront its consumption. Until private consumption strengthens and private investment finally stirs, India will keep posting impressive GDP growth, and its corporate sector will keep wondering, like Asian Paints MD did for a brief moment, where the boom is.